All right, we're ready to talk about the last concept in the class. All right, so you'll remember I drew up something like this on the board the very first day of class and said that this would be on your final exam. Okay, so we talked about this. I can't remember exactly what the example was, but we assumed that some firm today has an opportunity to invest $25 million in, I think it was a marketing campaign, and that marketing campaign will produce cash flows of $7 million next year, $10 million in year two, and $12 million in year three. And the question is should the firm invest? Is this going to be a profitable investment? You'll recall we talked about the goal of the firm is to maximize shareholder value, and they do so by investing in capital projects that are profitable. And we had this conversation the first day of class. Some of you added up 7, 10, and 12 million and said that equals 29 million, which is greater than 25 million, so the firm should invest. However, since that first day of class, we've learned a bunch about time value of money. For instance, $7 million today is different than $7 million 1 year from today, and $12 million today is different from $12 million 3 years from today. So what we have to do is we have to take the present value of these future cash flows and we have to add them up and see if in present value terms the future cash flows are greater than the cost of the marketing campaign or the cost of the project. Okay? And I think on the first day of class we said that we would discount these future cash flows by some rate R. We called that the discount rate. Well, what I want to introduce today is the cost of capital. This will be super important for those moving on to study corporate finance. So the cost of capital, we're now prepared, given what we've been covering over the last 10 weeks or so, to calculate the cost of capital. Let me explain. So the cost of capital is the weighted average cost of capital, or the WACC, all right? Let me explain this formula before anybody freaks out. Really all we're doing is we're trying to come up with a discount rate that we will discount back those future cash flows, and that discount rate is going to be equal to, I'm defining what WACC is right now, is going to be equal to the return required by those who have provided us capital. Okay? So before we even get into this formula, just understand in simple terms, the cost of capital is not a dollar cost. So the cost of capital is not measured in dollars. The cost of capital is measured in return. We have to get back a certain return, and it's going to be the return required by those who've provided us capital. Who's provided us capital? Well, we have debt holders, okay? That's this side of the equation. So if we issue bonds or we go to a bank and get a loan, so those who hold our loans are going to require a rate of return from us, the interest rate on the loan or the yield to maturity on our bonds. Those who've provided us equity capital are also going to require a return. Think of Shark Tank. In Shark Tank, when the sharks are giving equity capital to some of these entrepreneurs, they're in their head, they're requiring a return. It might be 30%, 40% return based on the riskiness of the venture. Okay, and so these sharks are also going to require a return. The difference between the return required by bondholders or debt holders and the return required by equity holders is that the return required by debt holders is collateralized with the assets of the firm. Okay, and we've talked about that it's cheaper to use debt to finance an investment project if you're the firm than it is equity, because it's less risky for debt holders to provide you capital because they have a claim on the assets of the firm in the case of bankruptcy. All right, let's go through this cost of capital equation very slowly so you understand. It's pretty straightforward. It's a weighted average. And basically what we're going to do is we're going to weight the return required by equity holders. So that's RE is the return required by equity holders. If they give us capital to invest in this marketing campaign, they're going to require a return. That's measured here. And what we're going to do is we're going to weight that return by the amount of equity financing. So E represents the financing with equity capital. D represents the financing with debt capital. So how much of the project are we going to finance with equity? How much of the project are we going to finance with debt? And of course, V is equal to total financing. So you can think of E over V as the weight or the percentage of financing that's coming from the equity capital multiplied by the return required by equity holders. Okay, so that's the weight of the equity financing plus the weight of the financing that's accomplished through debt. So D is the financing with debt capital relative to total financing, times the return required by debt holders. That's the interest rate on our loans or the yield to maturity on our bonds. And we're going to multiply this by 1 minus tau, where tau equals the marginal tax rate. Recall that when we finance with debt, we pay our interest before we pay our taxes. If we're the firm. Recall from an income statement in your accounting class that EBIT is interest before, or earnings before interest and taxes. So we will pay our interest payments to our debt holders before we pay our taxes. That means we get a tax break for using debt. That means that we're going to account for this tax break here. We're going to multiply by 1 minus the marginal tax rate. And that will ultimately lower the return required by our debt holders. Okay? Let me explain something here. RD is sometimes called the before tax cost of debt. Okay? And RD times 1 minus tau, or the before tax cost of debt times 1 minus the marginal tax rate, this product right here is the after tax cost of debt. Okay? So I'm going to, in parentheses down here, just so you have it for your notes, I'm going to say that RD times times 1 minus tau is equal to what we call the after-tax cost of debt. Okay, so make sure you get this. Before tax cost of debt is just the interest rate on our bonds, or the yield of maturity on our bonds, or the interest rate on our loans. And this product of the before tax cost of debt and 1 minus the marginal tax rate is called the after tax cost of debt. Okay, so we're going to work a whole bunch of problems here. Before we do, let's talk about how we're going to measure these things. Okay, so in the problems that I will give you in this class and on the exam, we're going to have I'm going to give you how much of the value of the project, the total financing, comes from equity capital, and how much of the total financing comes from debt capital. I'll give that to you. And now, how do we approximate the required return by shareholders, or what we call the cost of equity? Okay, the cost of equity, or the required return by shareholders, is measured 3 different ways. We're going to use the dividend growth model. So recall, this is just the dividend growth model. I just solved it algebraically for R, which was the return required by shareholders. So this is the dividend growth model, and we can approximate the return required by shareholders by using this model. Recall, we've also talked about average returns. The cost of equity could be approximated by just taking historical returns and taking the average of those returns. And more recently, we've used the capital asset pricing model, the CAPM model. And that gives us an approximation of the expected return, which is a function of the risk-free rate plus beta times the market risk premium, which is this, in parentheses here, the difference between the expected return on the market and the risk-free rate. Okay? Let me show you something here. This might be interesting. Give me a second to pull it up. There was a study conducted by a couple of guys from Duke, and basically what they did is they surveyed about 400 CFOs. Okay, let me actually pull this paper up. I think this might be interesting. Maybe I can just get it here. So they surveyed 392 CFOs about the cost of capital and about other things. Okay, and they asked the CFOs, what method do you use, or do you almost always use, when calculating the cost of equity or the return required by shareholders. In this class, we've talked about 3, okay? So it's kind of interesting. These CFOs responded to the survey. Let me show you what it looks like. Sorry, I'm scrolling down here. So here's the response from the survey. This is the percent of CFOs who always or almost always use a given method to measure the cost of equity or the return required by shareholders. Okay? And notice that the CAPM was by far the most popular method used to estimate the cost of equity. About 75% of CFOs said they always or almost always use the CAPM. The average historical return was used about 38%, 37% here. And the dividend discount model, the dividend growth model that we showed earlier, was used about 14 or 15%. Okay? So that's useful, I think. So the dividend growth model was used about 15% in practice. The arithmetic mean, or the average historical return, was used about 38% in practice, and the CAPM was used about 75% of the time. Notice that these sum up to something more than 100%, so that should tell you that these CFOs are probably using multiple ways to estimate the cost of equity, always or almost always using multiple ways. Okay? So I think that's important to understand. So think about what we're doing. When we estimate the cost of capital, we're going to be using information from a whole bunch of discussions that we've had during the semester. So, going back to this problem, look, the first day of class, we talked about this marketing campaign, and we talked about discounting these future cash flows back by some rate R. Look, you're gonna use, to answer this question, you're going to use everything that we've discussed in this class. You're going to use first the idea that the goal of the firm is to maximize shareholder value, and that means that they're going to try to invest in positive or profitable investment projects. We're going to use our time value of money here, right? So we're going to use the present value function to take the present value of these future cash flows. We're going to use a whole bunch of other stuff here, right? We're going to use our understanding of bond pricing to gather the yield to maturity on the firm's bonds to get the cost of debt, the before-tax cost of debt. We're going to use the dividend growth model from our understanding of stock pricing to approximate the cost of equity. We might also use statistics like the average historical return, or we might use the CAPM to find the cost of equity or the return required by shareholders. And so in order to solve this problem, this requires us to use pretty much everything that we've been talking about. And this will prepare you well, I think, for going into corporate finance. I think this will help, okay? Hopefully this all makes sense. What we're going to do in the next few videos is we're going to put this to practice and actually do a bunch of problems where we solve for the cost of capital. And in the very last problem that will work in this section of the class, we'll not only solve for the cost of capital, but we'll solve for the present values of these future cash flows from this particular investment project, and we'll see whether or not it's going to be profitable to invest.